Today, I'm diving into the challenge of taking over someone else's mortgage payments legally. Let's see if I can actually pull this off. When we think about taking over someone's mortgage, the first thing that comes to mind is, why would I want to do that? But the truth is, assuming a mortgage can be a win-win for both parties involved. For the seller, it can mean getting out from under a mortgage payment they can no longer afford, while for the buyer, it can be an opportunity to acquire a property with a lower interest rate than what's currently available in the market. One of the biggest challenges people face when it comes to taking over mortgage payments is the legal barrier. Oftentimes, lenders are hesitant to approve an assumption, especially if the buyer doesn't have a spotless credit history. Another issue is that many mortgages have a due on sale clause, which means the lender can call the loan due as soon as the property changes hands. Then there's the issue of seasoning, where the lender may require the seller to have made a certain number of payments before they're eligible to assume the mortgage. And let's not forget about the creditworthiness of the buyer. Is it good enough to take on the mortgage? Add to that the fact that lenders have different rules and regulations when it comes to assumptions, and it can be a real headache to navigate. For instance, some lenders may require the buyer to qualify for the mortgage all over again, while others may have more flexible rules. It's a complex situation, to say the least. And if you're not familiar with the process, it can be overwhelming. So, how do you overcome these challenges? That's what we're going to explore in this video. From loan assumptions to subject to financing, we're going to dive into the world of taking over someone else's mortgage payments and explore the possibilities. One of the most common methods of taking over a mortgage is through a loan assumption. This is where the buyer takes over the existing mortgage, and the lender agrees to substitute the buyer as the new borrower. It's a great option if the buyer has good credit and can qualify for the mortgage. Another option is subject to financing, where the buyer takes over the mortgage payments, but the seller remains liable for the loan. It's a higher risk option, but it can be a good choice if the buyer is willing to take on that risk. There are other options available as well, such as a wraparound mortgage or a land contract. While these options can be more complex, they can provide a solution for buyers who may not qualify for a traditional loan assumption. The key is to understand the legal implications of each option and to choose the one that best fits your situation. And that's where professional guidance comes in. A good real estate attorney or mortgage broker can help you navigate the process and ensure that you're making an informed decision. I want to share a real-life success story with you that illustrates just how taking over someone else's mortgage can be a game-changer. My friend Sarah was looking to buy a property, but she didn't have the credit score to qualify for a traditional mortgage. She found a motivated seller who was willing to let her take over their mortgage payments, and with the help of a real estate attorney, they were able to structure a subject-to-financing deal. Fast forward a year, Sarah's credit score has improved, and she's now able to refinance the mortgage in her own name. It was a win-win for both parties. The seller was able to get out from under the mortgage payment, and Sarah was able to acquire a property she loves. This success story highlights the key steps involved in taking over someone else's mortgage: finding a motivated seller, understanding the legal implications of the deal, and working with professionals to structure the transaction. It's not always easy, but with the right guidance and a little creativity, it can be a powerful tool in your real estate investing arsenal. So, to summarize, taking over someone else's mortgage payments legally is possible, but it does require some effort and creativity. From loan assumptions to subject to financing, there are options available, but it's essential to understand the legal implications and choose the option that best fits your situation. By doing so, you can unlock the potential for a mutually beneficial transaction that can help you achieve your real estate goals. Thanks for watching, and I'd love to hear your thoughts on this topic in the comments below. If you're interested in learning more about real estate strategies, be sure to check out my other videos.